So the next product we're going to talk about is balance transfer, which is transferring the outstanding loan amount, the balance, from lending institution A to lending institutions B. It's not really a value add in terms of a new house being bought, because the house has already been bought from the loan that you took from lender A. You are now moving your loan from that lender to another lender. So as a borrower, why would you move? Well, you would move for two reasons according to me. One, the interest rate that the new lender or the potential lender to whom you want to move your balance is significantly lower than what you're paying today. Well, the first thing you should do as a borrower is go to your current lender and suggest that he reduce the rates or offer you a new rate on the existing loan, failing which you will transfer out. Some lenders might reduce the rate, some lenders might say, sorry, we cannot reduce the rate, please go ahead and transfer the balance out if you want to. Just incidentally, they won't be so polite and easy in doing that transfer, but yes, in principle, you will be allowed to transfer out. Now, the other reason that you might want to switch your loan from lender A to lender B is because you are disgusted with a service deficiency. You're unhappy with something that lender A has done, and even though the rate might not be dropping from lender A to lender B, you just want to switch. Because it's like, why do you not go to a restaurant again? Why do you not buy a particular brand of something and buy the same thing, even if it is a different brand at a different price, which is higher or equal to the old price? Because you're unhappy with something that happened with the first lender. Now, when you do that balance transfer, you have to remember two or three things. One, look at the fine print. As a lender, the lender will say, yes, you can transfer out, but there is a prepayment charge. However, prepayment charges now by the regulators have been banned, and therefore lending institutions cannot charge a prepayment charge. More recently, because of the difference in rates between banks and housing finance companies are clamoring that we should be allowed to charge a prepayment charge when the loan is shifting from us to a bank, because we have done all the work and we need to recover some of those costs. The jury is out, and the central bank, which is the Reserve Bank of India, which is the regulator, has still not opined or given a final definitive guideline or rule on that. Now, the other point to look at is, are there any fees on the other side? The lending institution to whom you want to transfer your loan, whether they will charge you a processing fee or a legal fee or not, and that's a commercial decision that each lender will have depending on its own structure and policy. Once you decide to transfer out, you kick the process off, and the lending institution that you're moving to will do your appraisal, sanction your loan, get a confirmation that all the legal documents are lying with your original lender, and that on repayment, the loan amount, the documents will move from lender A directly to lender B, and that's the arrangement that most lenders have, and then disburse the money directly to lender A, who on receipt of their dues will close the loan, return the documents, and transfer them straight to lender B. Now that's a plain and simple balance transfer. A balance transfer out to lender A because the loan is going out, and a balance transfer in to lender B because the new loan is from lender B. The old loan is moving in to the new lender. Now, typically if there's a balance transfer after 2, 3, 4 years, two things could have happened. One, the loan amount outstanding with the original lender has come down because you have repaid something, and that is the outstanding balance that you will transfer. So say you took a loan of say 10 lakh rupees, the outstanding loan today is say 7 lakhs and 50,000 rupees. Similarly, the value of the property against which the loan you took, for which you took the loan, has also gone up. Say supposing it was 15 lakhs, it's now gone up to 20 lakhs. So original 10 lakh loan for a 15 lakh property gave a loan to value ratio of 66%. Now at 20 lakhs value with an outstanding loan of 8 lakhs, the loan to value ratio has come down to 40%. Now because it has come down to 40 and your servicing capacity has been judged by the new lender, they might say we will give you what is called a top-up loan. That top-up loan, based on the appraisal that is done on you by the new lender, and factoring in the current loan which you will continue to service now after the balance transfer, will be used by you for business and for any other purpose that you would do for a loan against property. And that is the attraction, that you move the balance loan. Not only do you get a better interest rate, maybe a lower one of course, but you also get some additional liquidity through the top-up loan if you so want, and your appraisal of your repayment capacity and the valuation of your property by the new lender actually allows the new lender to give you that top-up loan. So you will service that 8 lakhs which was the balance you transferred, and whatever amount of top-up loan the lender wanted to give you and or you wanted to borrow. It's become a popular product, a popular means by individuals like you and me as borrowers to play the interest rate game. Go to your lender and say, I'm shifting unless you reduce the rate, because overall the market rates have come down. Most lenders will be inclined to give you a reduction in rate, because if you've been a good customer paying on time, they don't want to lose your business. Not only the current loan, but even going forward. However, it is possible some lenders might be compelled to say, we cannot drop the rate, so if you need to move out, that's your decision. So let's now talk about two products which are not extremely popular or universally used by the lender or the borrower, but still do form a component of the mortgage and housing loan industry. The first is lease rental discounting, LRD. So what happens is, I own a property, and I own a property which I have rented out at say 1,000 rupees a month for the next 3 years. There's a lease agreement and I'm now earning rent on that. However, I want the money in a lump sum today. So 100 rupees or 1,000 rupees a month for the next 36 months is 36,000 rupees. I want upfront whatever I can get. So I go to a bank and say that I have rented this property to ABC. They are paying me 1,000 rupees. Here is the lease agreement for the 3 years. It could be for 9, but let's look at 3 just to start with. Please give me whatever you can upfront, because I need it for my business, or I need it for some medical emergency, or to pay for the education of my children, or to buy an asset like a house or whatever. Now, what the lending institution will do, it will say, okay, we will give you money, but two things. One, how do we make sure that the rent that you are receiving every month comes directly to us and you don't take it away in the middle and use it for something else? So what the bank will say is to open an escrow account where money will be deposited, the rental will be deposited by the person who has rented the property, and access to using that money is only with the bank. So what will happen is that as soon as money comes into that account every month from the person who has rented the property, the money will be taken away and used by the bank to repay its loan. Second point that is important is for the lending institution to be comfortable with the lessee also, who has taken the property on lease. What if the lessee walks away, either because the legally is allowed to break the agreement and the rental stops? If the rental stops, the repayment will also stop. Now, once he is satisfied with these two, will he get that 36,000 rupees, which is 36 months multiplied by 1,000? No, for two reasons. One, you got to make sure that 36 months, if that was the original term of the lease, how many months have already gone? If it's only 30, then that is the balance money that you're going to get. Here, the 6 months interest has already been paid. The second thing for you to remember here is that, as always, 36,000 rupees is coming in bits and pieces, 1,000 rupees a month over the next 36 or 30 months. Today's value of that has to minus the interest component. You have to bring it down to today's value, right? Very much like the balloon payment that we talked about earlier in this module, where the interest component has to be taken out from the monies that are coming. So for example, if it's a 3-year lease pending, let's not complicate it, and the person is going to pay you 1,000 rupees a month, the interest on this 1,000 rupees extra that he wants will be removed. The 36,000 will be discounted to today's value, and you as a lender will give the borrower or give the person who has leased his property maybe 31,000 rupees, because that 5,000 is the interest component over the period of 3 years. Again, like I said, don't worry about the numbers. They are just illustrative examples, but the fact remains that when you are, that's why the word discounting, rentals being discounted to today's value, because the bank is earning interest and the borrower is getting money today for otherwise what you would have got over the next 36 months, month on month. So that's the lease rental discounting product. The downside of that is rentals can change. If they go down, then the person who has leased the property and who's paying the rental every month can actually, based on a contract, walk away from the deal. In which case, the landlord or the person you're giving money to might not be able to lease the property at that value. If he doesn't lease that property at that value, then the servicing of the money that you have given up front, assuming that the amount will be 1,000 rupees a month, is no longer a valid assumption. So you have a recovery problem. So that's why it's not a very popular product in the market. It's selectively done for clients of banks who have other relationships, and therefore it's a strategic additional value add. And the discounting is done in a manner that it allows that if rental rates come down, then there is still not an exposed to the lending institution, and therefore they still have a buffer or a margin to recover that money. Okay, so now we are going to talk about the last product in this module, which is the reverse mortgage. Again, simplistically, what is a reverse mortgage? It's a mortgage that is done in reverse. Let's again, as our earlier capsules, start with an example. There is a couple, old couple, who has now retired. Both of them were working, they've retired. They own a house, but they don't have income to sustain their day-to-day expenses. Maybe they don't have children, or the children are not available because they're sitting in another country, they're not sending money, any other reason that it could be. They need, say, a certain amount of money every month to meet their food, expenses, travel, medical, etc. What they do is they go to the bank and they mortgage the property with the bank, right? What the bank will do in reverse is, instead of giving them a lump sum, will pay them a fixed amount of money, which is calculated based on like an EMI, and that fixed amount of money is for a period of 15-20 years, which is typically the balanced life of a person who's already 65-70 years old. That monthly installment that the bank is paying is used by this couple to meet their day-to-day expenses. It could be any expenditure, typically medical, food, travel, maintenance of the car, whatever it might, so a little bit of holidaying, whatever it might be. If something happens to both the individuals, then the bank will take over the house and recover the money it gave every month to the extent that it is given, sell the house and refund the balance amount to the heirs of the family. If by God's grace the couple survives the 15 years and the loan has been repaid completely, then they have to hand over the house to the bank, who will again sell the property and recover their money. Alternatively, some banks might consider giving another shorter term reverse mortgage loan. Now, both the individuals still need money to maintain their expenses. In fact, more so, because now that they're older, their medical expenses, for example, could have gone up. So that's the reverse mortgage, and it works brilliantly in the Western world. However, for the reasons that I'm going to tell you in the next couple of minutes, it's not been a product that has worked very successfully in India. In fact, over the last several years, I've probably had, I can count on my one set of fingertips in my hand, people who have asked me more details about this. There are certain public sector banks that offer it because it's a government initiative, the reverse mortgage. It offers security to an old couple who is looking to meet their daily expenses. But because people don't want to give up the house, the next generation of that couple might want to keep the house, and therefore they might be happier providing for their old parents rather than allowing the bank to give some money to provide for the parents' expenses and run the risk, not the risk actually, run the reality that at the end of the 15 years the house will belong to the bank. So it is a reverse mortgage product. It works. It has been offered in India. It still is by some public sector banks. It's worked very successfully in the US and Western worlds. But in India, where the family is more integrated and there are next generations living together, the product has not been very successful. Now, this brings us to the end of the module on products on housing finance. As you can see, it's not as boring, as simple and as vanilla as we all thought. A housing loan is not just a loan for housing. It's for various other things, for buying a plot, for constructing, for extending your house, for improving your house, for taking a loan to increase your money requirements for a business, for educating your children, for marriage, for medical emergencies, and more importantly is there are variations like a step-up loan for young professionals, a step down for people who are closer to retirement. You can have bullet payments where you can make lump sum payments with or without interest. You can do balance transfers depending upon interest rates, and so on and so forth, all making for a very heady cocktail of products and offerings by the industry, which gives you as a borrower a large amount of options to exercise, and you as a lender to make sure that you are meeting and catering to the needs of all kinds of borrowers who come to you through your bank doors to take a loan. Thank you very much again.